So now we are doing October, November 2023, paper 41, the source B. Read the source B. Please read the question.
G Limited produces a single product and adopts absorption costing. The budgeted and actual results for the month of July are as follows.
Okay, what do they want you to find? First question will always be a theory question for 2 marks.
Yes.
So what is the benefits of variance analysis?
Yes, it helps the business see how much money they're spending in which activity.
Hmm. Benefits,
It
what is
helps
a
the business
variance
see,
analysis?
yes, it helps you to see the variances between the budgeted and
What is
budget.
variance?
Yes, it's the difference between budgeted and actual.
Okay, so benefits of variance analysis is it helps you for forward decisions. It helps you to see where you've gone wrong and what were your strengths. It helps you to
Yeah.
achieve the targets. Okay, the next part. Read.
Sales volume as a measure of changing profit.
Okay, you have to calculate variances. So the first variance is calculate the following variance, the sales price variance. How do you get the sales price variance?
You multiply the actual quantity with
So this is the number of
standard price
units you
now.
had budgeted to sell, and this is the
Yeah.
sale. So can you give me the
Yes.
selling price that you had budgeted to keep? How will you get it?
73. You divide it.
146,000 is your sales. You divide it by 2,000 units. So selling price per unit is how much?
73.
73. What is your actual selling price?
76.
Sorry,
76.
76. So that means there is a difference of $3. Now in sales, you
Yeah.
have two variances, right?
Yeah, that's right.
What are the two variances?
Sales price and the quantity.
Quantity or sales volume?
Sorry, I want
Up you will multiply with what?
standard uh, standard rate.
You've messed it up. Up is volume, right?
Yeah, up is volume.
And down is
Price.
price. Then
Volume is yeah,
SR and AQ, correct?
right.
Now price would be what?
Standard rate.
Standard minus
Actual
into
and the quantity. So and the
SR
quantity.
AQ, right?
Yeah.
SR and AQ. You had expected to sell in how much?
Our budget was 73.
You had expected to sell in 73, but you sold in how
Yeah,
much?
76.
So this would be a favorable answer.
Yeah.
Correct? Quantity is
Yeah,
how
right.
much? Actual quantity is how much?
1,800.
So 1,800 into
Three negative two.
my negative.
Sorry, yeah. Sorry, three two. Because it's favorable.
Why? Because we just use this formula for our reference. But adverse and favorable, we have to decide.
Yeah.
Are you with me?
Yeah.
Okay, now the next one. What is the next one?
Sales volume as a measure of profit.
Okay, can you speak properly so that I can hear properly?
I've been speaking the same way.
You're lagging. Come on, again. Sales.
Sales volume as a measure of change in profit.
Okay, fine. That means you need the change in profit also.
Right.
Okay, can you again give me for sales what are the two variances we calculate?
Volume and price.
Volume and price. Above you will multiply with what?
SR.
Down?
AQ.
Okay. Now they want sales volume. That means you want standard quantity minus actual quantity. But instead of multiplying with SR, what do they want?
Further profit.
Okay, they want it as a measure of change in profit. So they want profit, right?
Yeah, right.
Okay, change in profit. What was the standard quantity that you expected to sell?
1,800.
Standard quantity.
Oh, we know 2,000.
What is the actual quantity that you sold?
1,800.
So you expected to sell more.
Yeah,
You sold less.
right,
So it would be adverse.
right.
Now you have to find the change in profit. How will you find it?
Miss, we multiply and pay with the
What is your budgeted profit?
14,000,
For how many units?
3,000.
So what is your budgeted
So it
profit?
is seven,
Sorry,
7 per unit.
7 per unit. Remember
Yeah,
always sales, volume, and price. You multiply with SR and AQ. Now instead of standard rate, they want what?
they want
Instead
the
of
profit per
standard rate,
unit.
they
Yeah,
want what?
profit.
They want the standard profit. So instead of standard rate, you will multiply it with standard profit. What is the profit? Standard profit.
7,
So it will
it's
be,
7,
so how much it will be?
1,400.
Adverse.
Yeah,
Are you with me?
yes,
Sure.
yeah.
Okay. What is the next one? What do they want next?
Direct material total.
Hmm?
Direct material total variance.
Okay. Direct material total variance. That means they want the total one. How will you find it?
Yes, it's divided into two.
Sorry?
Direct material is divided into two things.
Okay, fine. One direct material total variance. Direct material total variance. You have the budgeted direct material, right?
Yeah, yeah, we do.
Okay. What is the two variants of direct material? Can you tell me?
Usage and rate.
Hmm?
Usage and rate.
Usage and
Rate.
now look over here. When it's a direct material total variance, that means I want this. I don't have
Yeah,
usage separately. I don't have rate separately. Do I have it?
no.
And when we compare variances, we compare the variance of the flexed budget with the actual budget.
Yes.
Are you with me? So that means I know my actual direct material cost, which is how much?
It is 36,000.
Actual.
No, sorry, 33 for each.
33,408. What is flex budget? What does flex budget tell you?
It
It
is
gives you the standard rate for actual production,
yeah,
and actual budget gives you what? Actual rate for actual production.
yeah,
Does it give you this only?
no.
No. What does flex budget tell you?
Flex tells you the multiplication of standard with actual price.
What?
Tells you the multiplication of standard with actual price.
Actual production. You flex
Yeah,
it
that's
for the
right.
actual production, right?
Yes.
So flex budget gives you what?
This flex budget gives you the multiplication of standard rate into actual production.
An actual budget.
Actual budget is actual quantity with actual cost.
So actual production with actual rate. Yes.
Yeah, yeah,
Now I already have the actuals. I
yes,
already have the actual, right?
yeah.
Okay. I know the actual production also. What is my actual production?
Actual production is 1,800 units.
1,800 units. How about the standard rate? Can I get the standard direct material price?
There you can get it.
How?
The six is per multiplying that. That's like
I want to find the standard rate for material.
we take 36,000, we divide it by 2,000.
So 36,000 divided by 2,000 units.
Yeah,
So you will get what?
this would be divide 36 divided by 3, you get 18,000.
18,000.
Sorry, no,
What will you get?
you get just 18.
Hmm?
Just 18.
Just $18. So standard rate is 18.
Yeah,
Actual production is 1,800.
yeah,
So your direct material cost for actual production as per the flex budget would be how much? 1,800 into 18. So this is
yeah,
32,400. And this is
yeah.
33,408. So you estimated that your material cost would be how much? Total material cost would be how much?
This would be, hold on,
You estimated that your total material cost would be 32,400.
32,400. Yeah,
But it happened to be how much?
33,408.
33,408. So it is favorable or adverse?
It's adverse.
How much?
Just let me calculate it. By 1,080.
Hmm?
By 1,080.
Okay, I'm just so we're done with direct material total variance, right?
Yes.
Now what do they want us to find out?
Direct labor total variance.
And they want us to find out direct labor total variance. So whenever you have total variance, you should know that it is based upon the usage and rate. But
Yeah.
we don't have usage and rate separately, right?
Mhm.
At that time, we will compare our flexed with the actual. Actual labor, now tell me, how did you do it?
Yeah, for direct labor total, I took 64,000 and divided by 2,000.
1 minute.
So
What
that
is it?
gives,
What is it? First, tell me the
The
actual labor.
the actual is 58,752.
Sorry, 58. The actual labor is 58,752. Now you
Yeah,
want the labor as per flexed.
yeah.
So for labor as per flex, what will you multiply? Standard rate
Yeah.
into actual
Quantity.
actual quantity. Okay, fine. Actual quantity do you have?
Yeah, we have 2,000. Wait, no, 1,800. Sorry.
How about standard rate?
Miss, we can calculate that.
How?
64,000 divided by 2,000.
64,000 divided by 2,000. So what
Yeah,
is the standard rate
32 into 1,800.
into 1800? And then I will do minus 58,752. So this is the
So
labor
that's
cost as per
57,600.
flexed. So what
Yeah,
is this labor cost as per flexed budget? So this comes up to how much?
57,600.
And this is 58,752. Now you will see. You budgeted that it will be this much,
Yeah,
but it actually turned up to be this
yeah.
much. So it is how much?
1,152.
Favorable or
Adverse.
adverse?
Adverse.
Adverse. So this is with your direct labor total variance. Are you with me?
Yeah.
Now what do they want you to find?
Fixed overhead total variance.
Hmm?
Fixed overhead total variance.
1 minute. Fixed overhead total variance. How do you calculate the fixed overhead total variance?
Yes, the actual is 33,928.
1 minute, beta.
Yeah,
Fixed overheads total variance. So how do you calculate your fixed overhead total variance? As per flexed minus actual. Yeah? Are you with me? Umesh? Umesh, are you with me? So we have to find out the fixed overhead total variance. That means we will
Yeah,
do fixed overhead as per flex minus fixed overhead as per actual. Yeah?
yes,
What is your fixed overhead
yes.
as per actual?
It is 33,920.
It is 33,920. Now as per the flex. Now when you have to
It's
find out fixed
32,000.
overhead actual as per flex, you will find the OAR. OAR will be the
Yeah,
standard rate
yeah.
into actual production. Actual
Mhm.
production is how much?
1,800.
It is 1800 units. How do you get the OAR?
32,000 divided by 2,000.
Budgeted overheads divided by the budgeted activity level.
Yeah,
What is your budgeted overheads?
32,000,
Budgeted activity level.
2,000,
So how much is your OAR?
16.
So it is $16 is your OAR. Multiply by 1800 and this is your actual overheads 33,920. So what is your fixed overheads as per flexed?
28,800.
28,800. And what is your actual fixed overheads?
33,920.
So there is a variance, favorable or adverse.
Adverse.
How much?
5120.
$5120 adverse. So this is your fixed overheads total variance. Please remember putting
Got it.
this, and this is vital.
Yeah, miss.
Okay, come on. We'll
Yeah,
go
miss.
ahead.
Sure.
Come on. Read this question, the C part.
Explain the likely reasons for the direct
Just
labor
read
total
the
variance.
additional information, darling.
Okay, my bad. Yeah, each unit requires 2 standard labor hours. The actual labor hours are 3, 4, 5, 6.
Hmm. Explain the
Explain the
likely
likely reasons. Yeah,
for
for the direct
direct.
labor total variance.
Okay, fine. Now you know your direct labor total variance is made up of two things.
Yeah.
What are the two things?
Uh, Rate and efficiency.
Direct labor efficiency variance
Yeah.
plus direct labor rate variance. Yes?
Yeah.
Okay.
Yeah, miss.
So your direct labor, you will write the full form of it and then you will calculate separately. Efficiency variance,
Yeah,
that means volume,
yeah, miss.
right? Multiply it with SR.
Yeah, miss.
Okay, fine. So let's take the efficiency variance. How will you get direct labor efficiency variance? It is standard
Mess with
quantity
the stop of the hours. Yeah.
minus actual quantity
Mm-hmm.
multiplied by the standard rate.
Yeah.
Okay. Standard rate into standard quantity and standard rate into actual quantity.
Yeah, miss.
Okay, fine. You know your actual labor hours that you've used, right?
Yeah, miss.
It's how much?
Actually, labor hours sponsor.
3546.
Yeah. Right. Yeah.
Hmm?
3, 4, 5, 6. Yeah.
3456, right?
Yeah.
Okay. So actual labor hours that you've used is 3456.
Mhm.
Standard labor hours is how much?
The standard labor hours. Hold on.
2 per unit.
Yeah. So
That
I'm
means
just
it
gonna
will be
multiply
hmm?
4,000.
Sorry,
4,000.
how 4000?
Miss 2 per unit and our budgeted are 2,000.
But actual, you will take standard quantity for
Okay.
actual production, right?
Okay. Yeah. Right.
Standard quantity for actual production, actual quantity for actual production.
Yeah, miss.
So this is 3600
Yeah.
minus 3456. So you expected that you will use 3600 hours,
Yeah, miss.
but you used how many hours?
3,600.
So that means there is favorable variance.
Yeah.
How much?
144.
144 hours.
Yeah.
Standard rate is how much?
Standard rate is $17 per hour.
64,000 divided by 2000.
Yeah, right. 16.
So standard rate is 32. Yeah,
Yeah, miss.
it is your direct labor efficiency variance.
Yeah.
It's not yeah. What is a direct labor efficiency variance?
Miss hold on. Direct labor efficiency variance.
Standard rate is how much? Can you tell me please? 64,000
64,000 divided by this thing here, 2,000. That is 32. Fifty-four thousand divided by 2,000 will be 32.
2000 units and 2 per hour. Standard rate per
Yeah.
hour you will need, right? So this will
Yeah,
be
so you
4,000. So 64,000 divided by 4,000. So standard rate per hour. Now you're finding the individual.
so it'll be 16.
16. So what is the direct labor efficiency variance? 2304.
Mhm.
Yeah.
Yeah, that's right.
So the reason for your direct labor total variance was that you became more efficient.
Yeah.
Yeah, you became more efficient. How did you become more efficient?
Yes, it could be because we hired skilled labor.
So you became more efficient. You expected to use 3,600 hours.
Mhm.
You expected to use 3,600 hours, but you used 3, 4, 5, 6 hours
Yeah.
for 1,800 units. This could be because of skilled labors. So
Yeah.
you will elaborate it once. Okay.
Yeah.
Just understand this is for 6 marks. So you need to give good amount of calculation.
Yeah.
Now direct labor rate variance. How will you give direct labor rate variance? Come on. What is the formula?
Direct labor rate variance. It is this thing. Actual quantity into standard price minus actual price.
Volume and rate.
Yeah.
This is SR and AQ.
Yeah.
Standard rate minus actual rate
Yeah.
into
Actual quantity.
actual quantity. What is standard rate?
Hold on.
Okay. So basically your standard rate was for 2000 units. For every unit you required 2 hours.
Yeah.
So it was 4,000
No, it
hours.
was yeah 16.
So 64,000 divided by 4,000. So your standard rate is 16 per
Yeah.
hour. Yeah. Now what is your
Yeah.
actual rate? Actual number of labor hours is 3, 4, 5, 6.
Mm-hmm. So
Yeah.
it'll be 17.
So it is 58,752 divided by 3, 4, 5, 6.
That gives us
Multiply to
17.
by, yeah, 58,752 divided by 3, 4, 5, 6. So what is your actual rate?
17.
17. And what is your actual quantity? Means you will use your actual hours.
1800.
So your actual hours.
Ah, okay, okay, okay. So
3,
it'll be 3,
4,
4, 5, 6.
3, 4, 5, 6 is your actual hours. So your direct labor rate variance is 3, 4, 5, 6 into 1.
Yes.
Yeah?
Yeah.
Favorable or adverse?
Favorable.
Why favorable?
Wait, hold on. It's too small for me.
You expected to pay how much?
Yeah, 16. But
You
you paid
paid how
17,
much?
so adverse, adverse.
So it is $1 adverse.
Yeah,
So it
miss.
will be direct labor rate variance is 3, 4, 5, 6. Correct?
Yeah. Yeah, yeah, right.
Reasons for the same. Give me reasons for the same.
Miss, that was,
You had expected that you will get the labor at $16.
yeah, Miss, wages rate might have increased.
But you got the labor at $17.
Yeah, Miss, so like you paid more,
You paid more. Why you paid more?
increase in the wages.
Increase in wage rate. Why there
Yeah,
is an increase in wage rate?
because you hired
Maybe
skilled
because of
labor.
the demand. Maybe because they are high skilled labor.
Yeah, Miss.
Giving more efficiency.
Yeah.
Okay. So the direct labor total variance is a summation of direct labor efficiency variance, which is 2304.
Mm-hmm.
And this is adverse, right? 3, 4, 5,
Yeah,
6. So if you will do this, you will get what, favorable or adverse? Total.
adverse.
1152 adverse, which should be the same. You got this answer before.
Yeah, we did get it with
Yeah.
hours.
So this is the reason for your direct labor total variance.
Right.
Okay. Read the D part. First try the D part yourself. Direct labor, no, this will be direct material total variance. What is the reasons for difference between the direct material total variance?
Um, hold on, Miss. Miss,
Try it, read it, and then I will ask you. I'm giving you time.
okay.
Come on, read the question, dear.
Yeah. The standard direct material used for each unit is 3 kilos at $6 per kilo.
1 minute, wait.
The actual pricing,
1 minute, 1 minute. So your standard usage is 3 kilos. Your standard quantity. Yeah. And your
yeah,
standard price is $6 per kilo.
yeah, Miss.
Okay. Go ahead.
The actual price in July was 6.40 per kilo.
So your actual price is $6.4 per kilo.
Yeah.
Okay. Now
The existing supply,
read.
the existing supplier has announced that the direct material price it charges will increase by 5% from August.
Okay.
The
So the
directors have
direct.
approached a new supplier,
Hmm.
who quoted the price of 6.20 per kilo with a minimum order of 10,000 kilos per order.
Advise whether you should switch to the new supplier or
Near
not.
supplier.
See, you had actually you had actually decided or you had budgeted that you will get the materials for how much?
We budgeted that we could get the material for $6,
But you got it for.
6.40.
And now if it will further increase, if the price will further increase, it will become how much?
We increased by
105% of
5% to
6.40.
6.72. Yes, 6.72.
So it will be 6.40 into 105%. So it will become 6.72
Yeah,
per kg. Okay.
yes.
So as per the standard, okay, your standard usage was how much?
Yes, we can calculate that by dividing 33,408 divided
1800
by
units
the.
into 3 kilos.
Oh, okay, yeah, yeah. I thought how much you
Okay.
did in July.
So your standard
Yeah,
usage is 5400 kgs.
right.
But actually you used how much?
We used 5220 kilos.
Actually, you used how much? 33,408 was the thing, your material
Mhm.
cost. If you will
Yeah,
divide it by the rate per kilo, that is 6.40. So you will get your actual usage, that is how much? 5222
5220.
kgs. How do you get your actual usage? If you multiply your actual usage into price,
Mm-hmm.
you will get your
Yeah,
actual material price. So this is what we did the division. Okay.
yeah,
So your standard usage was, you expected that you will use 5,400 kilos,
yeah,
but you're actually using 5,220 kilos. So
yeah,
you
miss.
expected that you would use more kgs,
Yeah. But you
that you
use
would
lesser.
use more, but you use less.
Mm-hmm.
Why could you use less?
Miss, quality materials have been used.
Maybe the material is of quality material. Quality material is
Mm-hmm.
there, that is why they are charging you more.
Yeah,
And they are charging you more, and there is less wastage.
yeah, miss.
Okay. So if I go with my existing supplier, if I go with my
You'll have to
existing
pay.
supplier, what happens is, if I go with my existing supplier, I know that the quality of the material is good. I'm using lesser
Yeah,
amount of materials, approximately 180 kg less I am using. Okay. So if I do not
yeah,
adjust, okay, if I do not adjust the selling price, my profits will decrease because now they want to increase the material price to 6.72. That means they want to further increase it by 0.22. So if I
yeah,
stick
miss.
to my existing supplier, I am using good quality material, usage variance is favorable. But if they increase the material price further, my profit will decrease.
Yeah,
If
miss.
I want to balance that profit, I might have to increase the selling price. And if I increase the selling price, the demand may reduce.
Yeah, miss.
Okay, if this is the situation with existing supplier.
Yeah, miss.
If I go to the new supplier, what will happen?
You'll get a cheaper price.
You will get a cheaper price, which is much more cheaper than what we are paying, 6.2.
Yeah,
But what is the problem?
miss. The problem is that you'll have to buy 10,000 kilos at once. You have no option.
You will have to buy 10,000 kilos at once. But what is your actual kilogram
Exactly.
requirement? It is
5400.
5,000 to 5,500.
Yeah,
So that means if you go with your new supplier, you have to be very careful with the inventory control, the purchasing budget,
yeah,
the management of the inventory.
yeah,
If you don't manage the inventory, you might end up in spending, you will have spoilage cost. You will end up in spending more in storing the inventory.
yeah,
Also, you do not know if your new supplier is reliable or no.
yeah, miss.
You also do not know the quality of goods that your new supplier is going to give you.
Mm-hmm.
Okay. You are not very sure about what will happen. So, what
Yeah,
is
miss.
your advice?
Miss, I think that he should stay with his existing suppliers because they supply him with quality goods. He can use that to leverage his selling price.
Okay. Because if he will not opt for quality goods and he will order more, what he will save in the price, he might spend up in the spoilage cost and storage of inventory. Okay.
Yeah.
So with this, we complete the question number 2 of standard costing October November 23 paper 41.